I don't think it's going to be a bear market. I think we bottomed on April 8th. I think the economy is going to prove to be resilient. So we'll see some slowdown, but I don't think we'll see a recession. I think consumers are going to continue to spend, especially the retiring baby boomers. And I think capital spending, particularly in technology, will remain very strong. So that's my opinion, and that's therefore my opinion is, I didn't recommend selling out of the market. I still wouldn't recommend that.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When today's guest expert was last on this channel, he predicted that the financial markets would have a sloppy start to 2025, but then find their footing and rise to new highs, possibly as high as 7,000 on the S&P by the end of the year. Now, of course, that was before the new administration took office and all that's happened since then. So, is he still as bullish with his year-end outlook for stocks, or have recent developments like the Trump tariffs required a downshifting of expectations? To find out, we're fortunate to be joined by Dr. Ed Yardeni, president of Yardeni Research. Ed, thanks so much for joining us today.
Thank you, Adam.
All right. Well, as I said there, Ed, you had an outlook coming into the year. Now, obviously, an awful lot has happened in a short period of time this year. I'd like to get into sort of how that may have impacted your outlook. What have been the most meaningful macro developments since your last appearance here back in December, and how have they impacted your macro outlook, if at all?
Well, it's clearly Trump 2.0 and the policies that have been implemented on the tariff side. That's been the big macroeconomic shocker. Back in Trump 1.0, the administration back then started with the good stuff. They started with tax cuts, got them accomplished in 2017, and then they moved on to tariffs. So whatever negative impact the tariff discussion and policies had back then were more than compensated for by the stimulus provided by the tax cuts. This time around, the administration decided to start out with the tariff issue and certainly a much more sweeping approach to tariffs. And it took me a few weeks to recognize that this was not going to be a good situation. And so I did actually lower my expectations for the S&P 500 from 7,000 to 6,000. I did that in early March, and basically concluded that it might be kind of a flat year after all, not a double-digit year. But I moved my 7,000 target to next year, and then 8,000, 9,000, 10,000 by 2029. I'm still a believer in what I think we've discussed before, the idea that this decade may very well be justified. We may be justified in calling it the roaring 2020s. Now, it doesn't feel like that right now, but at least I got the first half of the decade right. That's worked out quite well for a while. I think that the economy is going to demonstrate its resilience. I think productivity is going to continue to make a comeback. And so I do have an optimistic outlook still for where this market's going. But in the interim, I did feel back in December that the market could be choppy for a little while until we kind of got the lay of the land of Trump 2.0. And I think I'm maybe it's wishful thinking, but I think kind of the worst of the negative consequences or impacts on the stock market might be behind us, and that we might very well have made a low on April 8th. So I don't think it turned out to be a bear market. I think it's turning out to be a correction. And I think we'll get some more choppiness, but by the second half of the year, I think we will be heading up to 6,000, which is not far away anymore.
Right. Okay. So we'll get into this in more depth, but just really quickly to take it off the table, sounds like you don't expect a recession this year. A lot of folks saying that the tariffs may trigger a recession.
No, I think I wasn't the only strategist, obviously, that reconsidered the outlook. There were a lot of us that were quite optimistic, and other strategists also cut their expectations for this year. Some maybe a little bit more than I did. Others maybe not as much. But I've been basically just indicating my concerns about a recession by providing a subjective probability, which the beginning of the year I thought 20%. I didn't think a recession was very likely. Then as I got the handle on just how disruptive the tariff policy of the administration would be, I raised it to 35% in early March, and then a couple of weeks later, I raised it yet again to 45%. So that's where I am now. So it's not my base case, but it's certainly a concern.
Okay. So it's not your base case, but it's getting close, right?
It's getting
45%.
close.
It's
Yeah,
close to
yeah.
50. So if we did have one this year, given the fact that you think markets are going to be, kind of roaring back in 2026, do you think it sounds like you think if we have a recession, it'll be contained to this year and not spill over.
Yeah, I do. Usually recessions are caused by the tightening of monetary policy, which causes a credit crunch. Uh, we had the tightening of monetary policy over the past couple of years, and we didn't have a credit crunch, and the economy continued to grow. I was in the camp that said that it would continue to grow, and I think the economy demonstrated its resilience. I think it'll do it again, but the tariff policies have created so much uncertainty that we could certainly have two negative quarters of real GDP. I know we just had one for the first quarter, but a lot of that was because of front running of
Right.
tariffs. We had a huge increase in imports. Final sales to domestic purchasers was actually 3%. It was actually a pretty strong quarter when you look at the final demand in the economy. And we may have a relatively strong second quarter because of front running, because of people buying cars before the prices go up, buying appliances before the prices go up. And then the second half of the year is when things could slow down. But between now and then, the 90-day postponement of so-called Liberation Day, that comes around July, and I think by then the Trump administration is going to want to declare victory, and I think they will have lots of pieces of paper signed by foreign governments agreeing to frameworks for doing trade deals. You can't do a trade deal in 90 days. You can't do a treaty. You certainly can't implement a trade deal in that short a period of time. But this administration needs to put this behind them. They need to be able to declare victory. I think they'll do that. And I think this issue will no longer hang over the economy. And the stock market's already acting as though it's just waiting for some of these pieces of paper to be signed with India, Japan, South Korea as templates, as frameworks for negotiating a whole bunch of other similar treaties or
So
agreements.
let me ask you this. Listening to you, it makes me think that had Trump not started the whole tariff tempest, your odds of recession would be a lot lower. That you would have,
20%. That's where I
yeah.
started. Yeah,
Okay.
I think this all has to do with tariffs, and I guess it was a lot of the rhetoric that we heard during the campaign seemed like that, like rhetoric, like bluster. The idea that tariffs are beautiful and that they can do so many things to make things better in the U.S. It was kind of hard to imagine that he really believed that, but he surrounded himself with some advisors that apparently, made and sold that snake oil, and as a result, the whole tariff situation has turned out to be basically Trump tariff turmoil, which again, I think even the administration is kind of learning by doing. They're realizing that they had to back off because the financial markets forced them to do that. Back on April 9th, when the president postponed the reciprocal tariffs that he had announced on April 2nd, when he postponed them on April 9th for 90 days, That was, he said, it was because the bond market was showing some turbulence, some turmoil actually. And so I think the financial markets have actually done a pretty good job of acting as vigilantes. I coined the phrase bond vigilantes way back in the early 80s. I've also been talking about the stock market vigilantes. I think the financial markets have made the Trump administration realize that they've got to moderate their approach to tariffs. That still leaves us, of course, with an outright trade war with China, and that's maybe where we get ourselves into trouble and a recession. Is there could be a situation where a lot of products that used to come from China are no longer available on the shelves, and that creates some problems for the economy. We heard that 20,000 workers for United Parcel Service will be laid off because UPS expects that shipments by Amazon will be down. So, we're already starting to see some signs that things are slowing down. But I'm counting on the resilience of the consumer, especially retiring baby boomers who've been spending a lot of money, and I think will continue to do so. I'm counting on capital spending to be surprisingly strong, as we saw in the first quarter. Data centers apparently was a big source of that boom, but so was information processing equipment. The AI revolution, I think, is creating a lot of demand for computing power. So cloud computing companies are doing well, as we saw by the announcement of Q1 earnings by Microsoft and Google. So a lot of moving parts here. A lot of uncertainties, confusion, and all that. But we all have to take sides here and kind of put all the pieces of the puzzle together as best we can, and that's the way I'm seeing it.
Okay, you're giving me a lot to react to here, which is great, Ed. So thank you. So it's interesting. You use the term snake oil, which maybe makes me think that you're not terribly impressed by the way that the whole tariff and trade war stuff has been executed so far. But the reason why I asked you if indeed your assessment of recession pre all the tariff stuff would have been lower is because if I were to ask the administration, I believe, what their assessment is they would say, look, this is necessary disruption that we needed to do to be able to put in place our grand strategy, which is right-sizing trade, bringing more foreign capital into the U.S. Than what we had before. It's going to be paired with our growth-oriented strategies like tax cuts and
Yeah,
deregulation and reshoring of manufacturing, the government trimming and DOGE efforts. So they would be saying, look, yes, we're going to go more slowly in the near term to go faster in the long term. What do you think about that? And if they are successful, I mean, is part of your grand, performance of 26, 27 and beyond, is it being increased at all by a sense of like, oh, if this administration is successful on these growth positive
sure.
policies, that's going to add tailwinds?
Well, it's interesting when Scott Bessent was nominated to be Treasury of the Secretary last year. I think it was around November or so after the election. A PDF of a memo that he sent around to his hedge fund colleagues at the beginning of 2024 became available on the internet. And in it, he quoted me. This was January of 2024, I believe, an internal memo that Scott Bessent passed around. It said that he quoted me saying that as a fellow on Wall Street talking about the roaring 2020s, this is exactly the kind of scenario that the Trump administration wants to see happen. He was betting that Trump was going to get elected, obviously, but he said if Trump would get elected, he'd be pursuing policies that would increase productivity, would be more business friendly, and so on. And I think a lot of us had this idea that once he did win, that animal spirits would drive the economy, which we did see some improvement in optimism indexes, particularly among businesses. But then the approach to tariffs has been controversial, and it's been disruptive. It's I can understand some of the tariffs as aimed at national security issues, like we want to be able to produce steel on our own, we want to be able to produce aluminum and copper on our
Right.
own.
Pharmaceuticals,
Yeah,
chips, yeah.
pharmaceuticals. Yeah, I don't really understand the 25% tariff on autos because that's going to break his um, one of his key campaign promises was to lower prices. And here we're going to have increased new and used auto prices. As a result of that, we're going to have increased insurance, auto insurance fees. It's going to cost more to maintain and repair autos. So just that item alone is going to be very, very troublesome. And then, of course, the tariffs themselves will lead to some increase in inflation. And already we've seen that inflationary expectations have increased rather dramatically. Um, if you're going to start a trade war, you want to make sure that you're prepared for it. And I think I get the sense that Besant and the president and Navarro really thought that if they really shut off the U.S. market to China, China would just kind of roll over and do whatever we wanted them to do, and that's just not happening at all. So I think they're a little bit in shock from all that. I think they thought we're going to get a deal pretty quick. Um, and by the way, speaking of trade deals, there were trade deals done during Trump 1.0. And here we are, Trump 2.0. And it seems like the conclusion is that whatever they did back then wasn't enough and needs to be completely renegotiated, as, for example, in our trade relationships with Canada and Mexico. So it's been awfully messy. Seems a little bit seat of the pants. Certainly, it doesn't look like a well thought out approach to how you do it. I think the end goals make a lot of sense. I mean, I think everybody on this planet that trades with China knows that they are unfair traders and that they take advantage and that they will in fact steal your intellectual property and then undercut you in global markets. And before you know it, you're out of business. And so all that is very, very relevant and needs to be dealt with. But as you said, there are consequences of these kind of policies.
Okay. So, look, a lot of this depends on how this all unfolds. And there's a lot in motion right now.
That's correct.
Obviously, the whole tariff situation is being negotiated in real time. Um, and there's the big tax bill that's getting put together. There's a lot of deregulation stuff that's going on. So we don't yet know how this story is going to unfold. And because of that, there is a lot of uncertainty, and that's obviously been reflected in stock market volatility. But it also gets reflected in spending, both capex by companies and household spending. And you're certainly hearing a lot of CEOs say, "I can't really make decisions right now," right? Um, I think a lot of the people who are worried about a recession are basically saying, "Hey, that's one of the reasons why they're increasing their odds of recession is because the longer that the purse strings get tightened,
Sure.
there's going to be an impact from that." Um, I mean, I guess you've sort of pre-answered this question with your 45% chance of recession this year, but how worried are you? How toxic is this sense of uncertainty? While, like you said,
Mhm.
you're not going to bang out necessarily a trade agreement with
Right.
a bunch of countries in 90 days. Maybe you'll sign memorandums of understanding, which is what the administration sort of been shifting their guidance towards, but you're not going to have the
Mhm.
trade deals in place.
Well, look, I think the important thing is that for a while there, it seemed as though the Trump administration was saying that they don't really care about the stock market reaction, which was very negative to what they were doing. And they said that their focus was on helping Main Street. Wall Street has had a long, good run. And so if Wall Street had to suffer a little bit, so be it. that's a little bit naive because 60% of Americans do have exposure to the stock market. And while not, well, quite a few have maybe a fairly small exposure, for them, it's an important component of their financial well-being, of their thinking about their future, and particularly for retirees. I think the administration, in that regard, did create some anxiety that they just weren't going to budge. And then it didn't take much to see that they would budge. In other words, for a while there, it looked like there was no Trump put, that the Trump administration would not respond to market forces and also to uh, appeals from the citizenry, from CEOs for consumer groups and so on, to ease off on the protectionism because of the immediate impact it was negative impact it was having on companies and households. So I think the fact that the president blinked, pushed the reciprocal tariffs to 90 days. I mean, the reciprocal tariffs were ridiculous anyways. It was done with some cockamamie formula that made no sense, and then it was divided by two just to show that the administration was willing to be very generous. But even dividing by two left a lot of countries with tariffs that were extremely prohibitive. But I think it was all to get attention, to get these countries to call the White House and say, let's work out some sort of trade deal. And again, I think it's just going to be letters of understanding. And I think the administration is going to take that. I think that's kind of helping to reduce the anxiety about the administration playing too rough, too much hardball and not enough softball with regards to protectionism. I think most of us would agree that if they just kind of focused on China and not picked on Canada and Mexico and allies, just kind of left well enough alone in the rest of the world, that would have been enough. So I think that's kind of where we are now. I think there's also a perception that if things really get bad on the economic side, the Fed will come in and lower interest rates. Look, granted, there's a lot of uncertainties, but we still have to kind of form our opinions. One opinion is things are so uncertain, I'm not going to do anything. I'm going to put everything into treasury bills. I'm going to take all my money out of equities. That's not my recommendation. We did think in December, looking at this year, that there would be some choppiness and volatility, and there was to the downside. It so far looks like a correction. I don't think it's going to be a bear market. I think we bottomed on April 8th. I think the economy is going to prove to be resilient. So we'll see some slowdown, but I don't think we'll see a recession. I think consumers are going to continue to spend, especially the retiring baby boomers. And I think capital spending, particularly in technology, will remain very strong. So that's my opinion, and that's therefore my opinion is, I didn't recommend selling out of the market. I still wouldn't recommend that. I did think back in a day or two before we made a low on April 8th, we wrote a piece saying that there's too many bears around. Bear sentiment was extraordinarily high. And said, things aren't anywhere near that bad. They're not going to be that bad. The market has a nice run, and it's about 10%, maybe less than that, below its all-time record high.
So we'll get into more depth here later in the conversation, but just at a high level, is this a time to be recommitting capital to the markets, or would you say volatility is going to continue for a while, kind of hang in there, and then as we get into the second half of the year, when things firm up, start deploying then?
Well, I've been bullish on the market since early November 2022. Back then, I said I think we made a low in October, and we were recommending technology, communication services included in that, industrials, financials, and they've done very well in this bull market. Uh, at this point, I would say those who kind of went along with our view or shared our view I would not be a seller. I would be holding on to the portfolio, and particularly in the areas that I just mentioned. They, of course, got whacked the most in this correction, but they're also are coming back the fastest. So that's my preference for now. And with regards to new cash, I think buying on the dip still makes sense. But things are cheaper. I mean, the Magnificent Seven, and you used to have a 30 multiple on them, and now they're around 22. 22 is a pretty good low multiple for companies that have shown the ability to grow very well.
Okay. And look, maybe we'll just pull up from what I was expecting to do. We'll just do it now. Can you repeat that list of ones that you've been bullish on since November 2022?
Yeah,
And you say don't sell. So it was tech. What else was in there?
yeah, the sectors would be the information technology, communication services, industrials, and financials.
Okay. Industrials and financials. Okay. Um, so you mentioned the Fed, and I'm glad you brought that up because I was going to get there. Um, given that your potential odds for recession have crept up to 45%, that indicates, some sense that the economy, is slowing this year or is going through
It's
a
vulnerable.
slowing.
Yeah,
Yeah.
it's vulnerable. Yeah, it's
Yep.
vulnerable.
And we saw the negative GDP print for Q1, as you mentioned. Um,
Which means
so
nothing because again, that was front running goods from
front
overseas.
running the tariffs.
Yeah,
Exactly. We had
yeah, and you take
massive
that out,
imports
and the
versus exports.
final demand was up 3%. So it was a strong quarter.
Okay. Um, but if indeed things are slowing, at least in the near term, presumably that will lessen inflation worries and give the Fed maybe perhaps enough air cover to start cutting. And I believe, I just checked this morning, it looks like the market is predicting the Fed is going to cut this year, maybe 3 or 4 25 basis points
Yeah,
cuts
yeah.
this year.
Over the next 12 months, the futures markets are saying 4 to 5 rate cuts over the next 12 months.
Over the next 12 months. Okay, great. I was looking out through December, but
Yeah,
okay,
yeah.
so even more. Yep. So do you think do you think that is more likely at this point?
I think it's more likely. I mean, if as I raised my subjective probability of a recession, certainly I'd have to conclude that Fed easing was becoming more likely. But as Fed Chair Powell himself has said a couple of times, especially since so-called Liberation Day when the reciprocal tariffs were announced, Powell has said that the Fed's basically boxed in right now because the tariffs turned out to be bigger than had been widely anticipated, and therefore inflation could be higher and not as transitory as was anticipated, and the economy could be weaker. So he said, we could have a real problem with our dual mandate because on the one hand, the unemployment rate is rising because the economy is weakening. And yet at the same time, the impact of the tariffs is to, at least on a temporary basis, drive up inflation. And, the last time the Fed dismissed inflation as transitory was in 21, 22, and it turned out to be more of a problem than they anticipated. And it was a source of embarrassment for them. So I think the Fed is in no rush to lower interest rates. A few Fed officials are. Christopher Waller, I think, is uh, auditioning to replace
Hmm.
Fed Chair Powell. He's basically agreeing with President Trump that the Fed should lower interest rates sooner rather than later. Whereas Powell is saying we don't really know when to do it, given this conflict we have in our dual mandate. So I think it's not inevitable that the Fed's going to be cutting the 45 times. I've seen this movie before. I've been through this before. Over the past couple of years, there have been a few instances where the market anticipated several rate cuts, and we said that just doesn't make any sense to us. And the same thing happened the last time that happened was in when the Fed started lowering interest rates last year and lowered them by 100 basis points. We said, the economy's the economy is actually in pretty good shape. What's the what's the rush to lower rates? So I think the economy will grow. I think there will be a temporary inflation problem. I think the Fed will hold off doing anything through the summer and then ask me again.
Okay. Where I'm going with this is uh, I want to try to get a sense of where inflation and where economic growth are going. And um, maybe first we could start with what difference, if any, do you see in uh, tariffs as quote inflationary versus a one-off price shock where it's a repricing, but then you don't have continued
Yeah.
inflationary pressure after that, right? They seem to be much more transitory is probably the wrong word, but it's do you see it? Do you see these tariffs as more likely lasting as a one-time price shock, or literally keeping inflation elevated, over the
Yeah.
course of a year plus?
Yeah, I think the term shock is relevant to this. It is a supply shock. It's kind of reminiscent of COVID. I mean, we may go into the stores this summer and some of the shelves may be empty because it just didn't make any sense to buy product from China with the kind of tariffs that have been imposed. And so that could certainly lead to the supply shock could lead to price increases the way that we saw during COVID. A lot of deja vu, as I mentioned before, with what's going on with autos. Putting a 25% tariff on imported cars and on imported components for cars that are assembled here. That could certainly be a supply shock that has a price effect and leads to increases in auto insurance and maintenance and so on. So yeah, it could be sort of like a mini version of what we had over the past few years when inflation's soared and then came back down, and a lot of that was supply disruption.
Right. And in that case, it took a long time for the supply chains to heal
Yeah.
because the world was opening back up at different rates and things like this.
Yeah,
Yeah.
what we don't know is the extent to which um, private industry has prepared for this. No one knew for sure that Trump would be back. Maybe if we knew that exactly, and we knew that Trump was going to uh, escalate the whole trade war situation, particularly with China, companies would have made alternative arrangements, but they may already have done that. The problem is that a lot of companies probably did, in fact, move their supply chains out of China into Vietnam
Right. India.
and India and Mexico. The problem is the administration, I think, as part of its framework with negotiating with a country like Vietnam, has said, well, one of the things we want you to agree on is that you're not going to be a backdoor for
Right.
Chinese products, and that could be a tough thing to enforce and to figure out how to implement.
Yeah. All right. Well, where I'm going with this is there are those out there for a lot of the logic that you've just laid out here saying that, hey, the concern going forward is stagflation, right? Is higher prices,
Yeah,
but slowing economic growth, right? And then
sure.
there are other sources, and one this morning is the administration, and of course they're going to put the rosiest view on it as possible, but they're actually talking about the opposite, that they point to a lot of prices that have come down so far under the existing administration, and that a lot of the trade rejiggering as the dust settles is actually going to make things um, more affordable, and as wages go up, as some of the other policies they're doing begin to kick in, that the future is going to be really more one of manageable prices, increasing household purchasing power, and increasing economic growth, whatever anti-stagflation is.
Sure.
So do you lean more one way versus the other as you look out with, say, a 12-month plus lens?
Yeah, well, I mean, basically, I lean both ways, depending on the time frame. I think over the next 6 months, maybe through the end of the year, We will have an inflation problem. Inflation, instead of being 2 to 3%, will be more like 3 to 4%. It could be kind of spiky like that, but I don't think it goes to the kind of levels that we saw during the previous inflation spike. And then I think it could come back down to 2 to 3% next year. Uh, once things have settled down on the tariff issue, and kind of we've moved on from all of this chaos, uncertainty, and turmoil. I do believe that the economy has a life of its own. One of the things I've learned over the years, and I think it still applies, is that it's amazing how well the U.S. economy has done and is able to do despite Washington's meddling. So, we always spend a lot of time in our business focusing on Washington, on the Fed policy is always something to discuss. And now we've got, we had Biden's deficit busting spending and onshoring. And now with Trump, we've got protectionism, at least with tariffs. I think the U.S. economy is going to deal with these shocks surprisingly well. And so I think once we get past the shocking period between now and the end of the year, I think 2026 will be a very good year, and so on. I think technological innovations are going to become more used and purchased more on a widespread basis. I think autonomous driving will have a tremendous impact on the auto industry and how we use cars. I think humanoid robotics is probably a year or two at most away from actually being implemented on assembly lines and maybe other areas in some areas of services. So the future is kind of here, and I still think that we're in the roaring 2020s, and that 2025 was sort of a transition year, an interruption in the roaring 2020s. And so far, my reading is the stock market agrees with me. We got to an all-time record high on February 19th. February 19th, it wasn't that long ago.
Right.
And now, after all the craziness we've seen, we're down less than 10%. And we've had some of these stocks come back real strong. We've seen the Magnificent Seven, which really led the correction. They were down over 25%. They had a bear market, but it didn't last very long. And all of a sudden, they're reporting great earnings, and people want to own them again.
So to your point, this is maybe just a rebuilding year. I think the administration would say, hey, we're taking a step back to be able to take, a bunch of steps forward going from here using, sort of similar to the new roaring 20s. What are they using? The new golden age of America, right? So they're actively trying to manufacture the boom that you're talking about. And I'm curious, Ed, just hearing you talk, in addition to the many advantages that America has, both, geographically, governance-wise, economically, et cetera, is part of your optimism here, your confidence here, just the magic of the capitalist model, right? Which is, when things change, once you get a little bit more certainty,
Yeah.
the profit motive will drive innovation, creativity to find ways forward.
Yeah, I mean, you caught me. That's exactly where I'm coming from.
Yeah.
At the end of the day, I really am a big fan of entrepreneurial capitalism, and I think it's still alive and well in the United States. We have something like 30 million proprietorships in America. Companies like mine, little companies owned by individuals, and there's no safety net for what we do, and we work real hard and try to make a living and try to make things better for ourselves, our families, our communities, and the country. And we don't view Washington as being very helpful. We view Washington as just being annoying, and yet we somehow work around it and play by the rules and make things make things happen. So yeah, I wrote a book not too long ago called "In Praise of Profits," and I actually dedicated it to progressives because I figure I'm not writing this for people who agree with me. I'm writing this for people who disagree with me, that, socialists basically. I said, let me explain to you why profits works and why it creates more prosperity, and it's a better system than socialism. And so, yeah, I'm a big fan of free market capitalism. I am opposed to crony capitalism, but doesn't matter what I think. I mean, the reality is crony capitalism exists. There's a lot of it. There's socialism out there, even in the United States. But it's free market capitalism that works. And by the way, if we go over to China and look at the history of China over the past 30 years, the reason they've had all the success is because the Chinese Communist Party had the enough intelligence to kind of step aside and allow free market capitalism to work. The problem is it worked so well, and the standard of living improved so quickly, and the market is so huge there that you suddenly got multimillionaires and billionaires that were very powerful. They were generating a tremendous amount of income, wealth, and so they were becoming too powerful. And so a few years ago, the Communist Party said that's enough. We're going to start squelching it. And meanwhile, during that period of free market capitalism domestically, they cheated on the rules of world trade. Yeah, I'd say the system matters.
Okay, and particularly in regards to America, sounds like you would agree with Buffett. Don't don't bet against America in the long term.
I think that's wise advice.
Okay. All
Yeah,
right. By the way,
I'm curious. I'm curious to see when he starts buying again, and whether his purchases will, will be good ones. Uh,
well, actually, that's a good point here. And real quick, before I ask that question, In Praise of Profits, can that be bought wherever books are sold?
yeah, it's at Amazon.
Okay, great. Yeah, so a lot of people point to Buffett, who, by the way, famously created the Buffett ratio, the Buffett indicator, which is still very elevated right now. A lot of folks are saying, well, because of that, he's just been sitting on cash for a long
Yeah.
time. And of course, he's got some limitations, right? He can't buy small companies. He's got to make, at this point, given his company size, they've got to be really big acquisitions. But people are saying, hey, he's just not finding good value right now, and so he's sitting it out, right? He's waiting for better values over time. Um, in some ways, that kind of stands in contrast to your growing enthusiasm that, hey, it's time to start getting back into the markets right now. Um, is that a false signal his cash hoard is sending, or is it a difference of
No, I
opinion?
mean, look, Buffett's, the sage of Omaha. I mean, the guy's has an amazing record, great instincts, great insights, and he might have seen this coming. I mean, he did quite a bit of his selling before he knew who was going to be the next president. Maybe he concluded no matter who was going to be the president, either one of them would screw up the country. But I think he was looking at his Buffett ratio. I think he was looking at valuation, and he looked at and I think he benefit of hindsight. He was right. Valuations only made sense if we weren't going to have any risk of a recession and there wasn't any risk that policy would screw up. And I think he realistically came to the conclusion that things don't always go perfect, and if you got valuations if stocks are priced for perfection, you're going to have some disappointment. So I think he nailed that perfectly right. I'm just really curious to see when he'll decide that it's time to buy again, and you know maybe he's still looking at that Buffett ratio, and as you said, it's still elevated. But I'd point out that the forward PE of the S&P 500 bottomed at 15 in October of 2022. And a lot of people said, there's no way that a bear market bottoms at 15. It's got to be 8 to 10. And I said, well, yeah, but if we don't have a recession, then maybe that rule doesn't apply anymore. And maybe Warren Buffett's waiting for a recession and waiting for valuation multiples to go even lower. And I could be wrong, and he could be right. He's got a better track record than I have, at least in terms of monetizing his ideas. So I do kind of watch the Buffett ratio, and I also watch the news that reports what he's doing.
Mhm. And I'm sorry to be all over the place here, but you keep bringing up such great points that trigger, these
No
key
problem.
questions. Um, so you were correct. You accurately called the bottom in 2022, um, and your bullishness was rewarded in spades over the next 2 years. Um, One can make the argument that it wasn't just sort of natural market forces that led to the bottom, that it was a lot of liquidity, a lot of net positive liquidity that was unleashed into the system. And this was through government fiscal spending. This was through draining of the reverse repo program. It was through the bank term funding program that was instituted when the banks started getting really shaky. Um, we have a new administration right now that is at least giving lip service to trying to get fiscal spending a little bit more under control. Um, could it be not quite apples to apples here from a liquidity standpoint?
There's still plenty of liquidity around. I mean, money market funds, I haven't looked at it the past couple of weeks, but I think we're talking about over $7 trillion in just in money market mutual funds. There's a lot of money in bank deposits. There's a tremendous amount of liquidity in the system. Liquidity is a funny thing. When the market's going down, everybody says liquidity is drying up, and then when it goes up, it's like, oh, look at all the liquidity that's out there. No, I think that the bottom was made by extreme pessimism. We had the bull bear ratio down, I think it was zero point 0.6 or zero point 0.7. It was as bad as it had been during the great financial crisis. And in addition to that, I think the market started coming around to the view that I had been pushing, and that is that we had just experienced the most widely anticipated recession of all times that never happened.
Right, it's never materialized, yeah.
Yeah, it never materialized. I think at some point, investors just got tired of being spooked by the pessimists who said, a recession's here. Look at the leading indicators. Look at the inverted yield curve. They had a whole litany of tools, and I said, these are not going to be work. These aren't working right now because we're not getting a credit crunch, and without a credit crunch, we're not going to have a recession. The question now is, if we don't have a credit crunch now, which we don't, the bond market was a little spooky there in early April, but it's calmed down pretty nicely here. We know that the Fed will help if necessary. So the question is whether tariffs all by themselves can cause a recession, and the answer is, well, Smoot-Hawley caused a depression, so you don't want to. It's not nitroglycerin. You don't really want to mess around with it.
Yeah.
But if the president's going to continue to blink and back off and is going to declare victory, as he's wont to do, then it should be much less of an issue, and we can move forward. And there will be an extension and a continuation of the tax cut. It's not a tax cut. It's just a continuation of the tax cut. But I don't really need monetary and fiscal policy to make the economy work. The magic is technology. The magic is productivity and the entrepreneurial spirit of Americans.
Okay. So to the extent that additional net liquidity does actually make a difference in your model, it's just adding fuel to the fire, but the
Yeah,
fire
yeah,
itself are those things that you mentioned. Okay.
yeah.
All right. You brought up, I wanted to end on bonds, which we can.
Sure.
You brought up one more point too that just fell out of my brain, but if it pops back in, I'll ask about that too.
Okay.
Um, so, we had a bit of a kerfuffle in the bond market. Folks got real nervous when the 10-year got back up to 4.5, which it was at 5 not that long before.
Yeah.
But the reason I think why 4.5 was so scary was because it happened so quickly that
Yeah,
you
we
had
went
some.
from yeah, we went from 4 to 4.5 like in a couple of days.
Yeah, so you had some big players who were big in the basis trade who were getting caught, basically with,
Right.
overexposed, right? So there were some potentially systemic concerns, although, it doesn't matter what I think, but I hate to think that these big hedge funds are systemically important. I think that they should just eat their losses and,
Mm.
take their lumps. And even Treasury Secretary Bessent, at the time said, hey, this is a, you know, this is something that's going to work its way out as these companies work to repair their balance sheets. It's not a credit crisis, like you said, right?
Yeah.
And that seems to have been the case, and the 10 years marched back down. I think it's around 4.1 the day that we're talking here. Now we know that the administration really wants those yields to go even lower, right? You
Yep.
talked about the Fed about the fact that the Fed may cut multiple times later on this year and into next year, and that even though that's on the short end of the curve, that should also help a bit. Where do you see bond yields going from here? Do you see them going lower? Will they have a three handle at some point this year?
Yeah, I mean, it's obviously it's a possibility if things get weaker than I'm anticipating right now. But we've been arguing that the bond yield should be around 4.5% plus minus 25 basis points. That to us is normal. That's where the bond yield was before the great financial crisis, and the economy has demonstrated in recent years that it can handle these kind of interest rates, and that these are kind of normal interest rates. We need normal interest rates that can properly allocate capital in the credit markets, in the equity markets, uh, and the economy is doing just fine with these level of interest rates. I think productivity growth has shown an improvement over the past few years. Will continue to do so, and if productivity growth continues to improve, that would argue that the so-called real interest rate to which the economy can grow is higher. And so I don't think that the Fed officials think that the Fed funds rate is restrictive here. But again, they're in no rush to lower rates because they think that maybe they need to keep it restrictive to keep inflation from picking up. But I think the Fed funds rate is pretty much where it should be, and this is where the bond yield should be. You know, uh, we're already below my, the bottom end of my range of 4.25. But we've been seeing this before and kind of bounced right back into that kind of range.
How about, so I get your argument there that the underlying strength of the economy, improved by productivity, can support current yields and maybe even higher ones. On the government side, I think there's increasing concern about how much the debt service costs has jumped, right? Um, you know, for
Yeah, trillion
whatever,
dollars.
for better or worse, Congress got used to financing itself during the ZIRP era, right? Um, how do you just sort of, or how much of your forecast factors in the government's need to get down its borrowing costs?
Well, the government may need to get its borrowing costs down, but doesn't really mean that they have a lot they can do about it. Bond yields are determined by a lot of factors. The Fed's important, inflation's important, supply and demand is important. Uh, yeah, the administration has made it clear that they'd like to see interest rates lower, and for a while there, Trump did not beat up on the Fed, and that didn't last long. And now he's beating up on the Fed to lower interest rates. Look, you have very smart people like Ray Dalio basically arguing that the jig is up. We're going to have a debt crisis here very shortly, almost implying that there'll be auctions where nobody shows up. I mean, that's never going to happen. There's always going to be some level of the bond yield at which there'll be plenty of buyers. The only question is it, can the economy live with it? If it takes a bond yield a bond yield of 6% to attract buyers, and at 6% the economy gets crushed. Obviously, that's not a good scenario, and it would indicate that politicians might start to panic and realize that the bond vigilantes have taken over, and if they don't get their act together and reduce the deficit over a meaningful period of time, that it's going to be chaos for the economy. So look, the deficit is a man and woman made problem. It's very easy to fix deficits. All you got to do is slow down outlays and increase revenues. Doing it politically has been almost impossible, and it may very well require some sort of debt crisis that maybe we had a glimpse of in 2023 when the bond yield went from 4 to 5% in a matter of 3 months. And maybe we saw a glimpse of that in April when the bond yield went from 4 to 4.5%. Um, To me, that this is good news. This is shows that the financial markets are powerful. They have a checks and balance power to get the politicians to wake up and smell the coffee and kind of deal with the reality of what needs to be fixed. But at the same time, the Treasury has demonstrated that they know how to play the game too. And as Janet Yellen did on November 1st of 2023, she basically told the bond vigilantes, well, if you don't like all my bonds and notes, I'm not going to increase the issuance. I'm just going to do what I need in the bill market. And that was at 5% on the bond yield, and bond yields came tumbling down. So I don't, I've often said that I'll worry about the deficits and the debt when the bond market worries about it. And right now, the bond market doesn't seem too stressed about it.
Okay. Well, and the last question here, and then we'll wrap up. So if you hear the administration talk, and certainly folks like Scott Bessent from his earliest days and stepping into his role, really talked about what got him and a lot of the other economic cabinet members to basically step away from their successful private lives and come on in, was this sense of like a Dalio-esque debt crisis that was inevitable if we don't change our trajectory. And so if we take them at face value, that seems to explain a lot of the exigency with which they are operating right now to get all these different things done, pretty quickly. The trade renegotiations, the tax cuts, the government shrinking, the hopeful deficit reduction, all this stuff. Do do you have any confidence that I mean, even if an administration kind of feels the pressure, obviously Congress has to come along in the long run to get the power, the purse
Yeah.
strings into play. Do you have any confidence that this can be done proactively by a motivated Capitol Hill, or human nature being what it is? Is it going to take a crisis to finally force the reforms that might be needed?
Door number two.
Okay, boy, I like that you didn't even have to think about it.
I didn't even think about it. I mean, politicians just aren't going to, on their own, do the right thing. There's going to have to be some pressure brought, and I just have. I'm a big fan of the financial markets. They're free market, stock market, free market, bond market. We have a lot of debt. We got a record amount of debt. On the other hand, the bond market, because the bond market's so big, it's never been this powerful. And so, yeah, it may take a debt crisis. Doesn't have to be the doom and gloom end of the world that some people are saying. Quite the opposite. It could last a few weeks, and the politicians could get the message and get their act together. They know what they have to do in order to reduce the deficit. When Scott Bessent was auditioning for his job as Treasury Secretary, he said, he wanted to one of the things he wanted to do was to get the deficit down to 3% of phenomenal GDP from
Right.
6% currently. And he basically implied that the way he would do it is by having a roaring 2020 scenario, strong economy, good productivity, and so better than expected growth. I don't know that what he's doing right now is really helpful in that regard. But on the other hand, I've got a lot of confidence that the economy is going to do well despite Washington.
Okay. All right. Well, look, as we wrap up here, we already sort of had the investing conversation, but what I took from you, please correct me if any of this is wrong, is, hey, if you're one of just the regular investors watching this video, don't get too worked up about the volatility going on in the markets right now. Stay long your positions, especially if you're holding IT, communication services, industrials, or finance securities. Look to buy on dips if dips provide even better valuations to buy in at, and
Yep.
then feel pretty optimistic about the next 2 years, 26, 27.
Yeah, optimism has been a winning strategy for a long time.
Okay, and you don't see that changing, obviously, anytime in the near future.
No,
All right, well, Ed, thank you so much. Most important question for folks that have really enjoyed this conversation, would like to follow you and your work, where should they go?
they can go to yardeni.com And there's an option there to do a trial for the institutional service. And then there's a research service for individual investors called YardeniQuickTakes.com that might be very helpful for a lot of people who would like to understand the relationship of the economy to the stock market and the bond market and commodity markets.
All right. And Ed, as somebody who gets your excellent work, I'm always impressed at the volume that you and your team are able to put out there. If you're wondering what's going on in the markets and what to think about it, if you subscribe to Ed's services there, you won't be wondering anymore. You'll be being kept very well informed.
Thank you so much.
All right, Ed. Well, again, I can't thank you enough here. Folks, if you've enjoyed this conversation and would like to thank Ed for coming on and encourage him to come back on again in a quarter to give us an update on where he sees things, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And just a reminder, if you are looking for help in figuring out how to navigate your wealth through both this interim uncertain period of tariffs and all that Ed and I have talked about, but also setting your portfolio up for success going forward, especially if we have the positive years ahead in 26, 27, beyond that Ed sees, then highly recommend that most of the people watching this program get that help from a good professional financial advisor, and importantly, one that takes into account the macro issues that Ed has talked about here. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you even just like a second opinion from one, then consider scheduling a free consultation with one of the financial advisory firms endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. To set up one of those free consultations, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. Again, those consultations are totally free. You'll get their personalized professional advice on what they think you should do. You can do with that whatever you will. And again, there's no commitments involved. There's no pressure to work with these firms. It's just a service they offer. All right, with that, Ed, can't thank you enough. It's been wonderful as always. And yes, I'd love to have you come back on in Q2. And in the interim, best of luck continuing to do everything that you do.
Absolutely.
All right. Thanks so much. And everybody else, thanks so much for watching.